What's up, everyone? It's Scotty with MoneyVest. So in this video, I wanted to break down everything that Jerome Powell said during his 60 minutes interview. And I'm going to break down all the key important pieces of information because there was a lot of really interesting stuff related to rate cuts, politics, fiscal policy, national debt, and of course, inflation and interest rates that he talked about. So hope you all enjoy this video and find it helpful. Make sure that you drop a like and don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us and of course getting access to all the members only private videos, including all the fair values and watch lists, and as well as the trading view charts and the trade alerts, spines alerts, options alerts, everything's going to be included with the link down below. And of course, the first week of the month is the best time to join. So first things first, the first question was, is inflation dead? And to which Powell says that I wouldn't go as far as to say that. What I can say is that inflation has come down really over the last year and fairly sharply over the last 6 months. And that's exactly what Jay Powell mentioned in the FOMC meeting as well, which he basically mentioned that we're making good progress. Look, the last 6 months have been very good, and we're looking for that continuation of that good inflation data that is trending lower. We're not looking for better data. We're just looking for the continuation of the good data that we've already seen over the last 6 months to give us a better, greater confidence that inflation is indeed moving closer and closer to our target. The job is not done. So he mentioned that, we're not declaring victory, and we're very much committed to making sure that we fully restore price stability for the benefit of the public. And we have a strong economy, as we already know. The labor market's so tight. And of course, it was a very, very surprising print on last Friday when we got the unemployment report for the month of January. And growth is again going on at a solid pace. The labor market's strong, 3.7% unemployment, and inflation is coming down. With the economy strong like that, we feel like we can approach the question of when to begin to reduce interest rates carefully. So they're kind of warming up to the idea of interest rate cuts, as we already know that the FOMCs have kind of penciled in their summary of economic projections that they are going to cut rates at least 3 times this year, but the timing of those rate cuts is of course unknown and somewhat uncertain. So again, he mentioned that we want to see more evidence that inflation is moving sustainably down to 2%. We have some confidence in that. Our confidence is growing, it's rising, and we just want to make sure that our confidence, some more confidence before we take that very important step of beginning to cut interest rates as well, which I'll dive more into later in the video. Now, he also mentioned that they're not exactly looking for 2%. So of course, the Fed's target, as mandated in the monetary policy, is 2% inflation, but they're not looking for exactly 2%. So he mentioned that we are committed to returning inflation down to 2% over time, so over a long period of time, and we wouldn't wait to get to 2% before cutting interest rates. That's actually what was very, very interesting and somewhat different than what he mentioned in the FOMC, because he did mention that, that's our anchor point. That's really what we want to get down to. But I guess the only thing that he didn't mention in the FOMC is that they're looking for that number over time, and they would not wait for inflation to come down to 2% before cutting interest rates. So it could be it's possible that it's down to 2.5%, 2.7%, and they're already looking to cut interest rates because they don't want to obviously hold interest rates higher for longer, and then of course putting pressure on the economy over time as well. So they are not going to wait until interest rates get cut. They could do them earlier before inflation even gets down to 2%. He also mentioned that we're focused on the real economy and doing the right thing for the economy and for the American people over the medium and long term. And I can't overstate how important it is to restore price stability, by which I mean inflation is low and predictable and people don't have to think about it in their daily lives, because that's really what happened for 20 years. Inflation was so low, 2%, sub 2%, that people didn't really talk about it. It wasn't part of their daily conversations. And now, of course, prices have risen so much that it is a constant sort of dissatisfaction among consumers, among people in the US. Not only that, they're also kind of worried about their wallets and their budgets and their savings. And as a result, the goal is for them to restore price stability to a point where they can go back to those 20-year period where inflation was so low. So he mentioned that we want to get back to that, and I think we are on the path to that, and we just want to make sure that we kind of achieve that goal over time as well. Now, he also mentioned that the risks of moving too soon or too late need to be balanced. In other words, too soon could be if he basically cut rates too soon, that could reaccelerate inflation back up. And if we move too late, that could obviously put pressure on the economic activity and create a recession, or possibly spike unemployment once again. So basically, the idea is to move very, very carefully, move cautiously, and take it, data by data, like whatever economic reports are coming out. But they're walking a very fine line, which I've already mentioned that they're kind of in this, environment where they need to decide whether to support inflation or whether to support the economy, because if both things start moving in the wrong direction, that's the worst place the Federal Reserve wants to be. He also admitted, that, FOMC admitted, so in hindsight, it would have been better to have tightened policy earlier. I'm happy to say that. And we saw that we thought that inflation was transitory and mostly limited to the goods sector and the supply chain story. We thought that the economy was so dynamic that it would fix itself fairly quickly, and we thought that inflation would go away fairly quickly without any intervention by the FOMC, by the Federal Reserve, and that it would be transitory. And of course, it was a widely held consensus view, which ended up being wrong and ended up being, of course, somewhat not the case for inflation, because it wasn't transitory. It was kind of entrenched in the system, in the economy. And so in the fourth quarter of 2021, it became clear for the FOMC that inflation was not transitory, and it kind of gave them a sense on what to do next, which is exactly why they pivoted and started tightening up very, very aggressively, started dumping bonds in the market, and of course, not to mention increasing interest rates very, very rapidly. And it's essential that we did that. It was critical that we did that, and it was part of the story why inflation is now coming down, because there is a lot of disinflation as well. One more thing he mentioned, which was quite interesting, is that almost all FOMC members, 19 members, almost all of them are on board that it would be appropriate to cut rates at some point this year. So all the members, almost all of them, are on board. So there could be a unanimous decision that they are looking at cutting rates at some point in 2024. And most of the disinflation he mentioned has happened on the supply chains easing and the semiconductor shortages going away. So a lot of them have, of course, resulted in goods inflation coming down, in the overall price levels. And something that I've discussed in my previous videos is that, inflation is somewhat relative, because when we look at inflation coming down, and when Joe Biden or Jerome Powell or anybody quotes inflation and is like, okay, inflation's at 3% or 4% or 5%. So what does that number basically mean? That number essentially states that prices over the last year are up 2 to 3% or 4% or 5%. Whatever that number is, that's what that means. But another way to look at inflation is the price index, the inflation price index, the CPI price index. Because if you take a look at that, you'll notice that over time, inflation has been very, very significant. Prices of milk, butter, sugar, eggs, bread, everything has been going up over time. And that's what tends to happen in a very strong, good functioning and working economy, because you don't want to see deflation, right? You don't want to see prices going down every single year, because that's going to hurt the earnings, that's going to hurt growth, that's going to hurt the markets, that's going to hurt prices. Everything's going to move in the opposite direction. So you want to see growth, you want to see prices going up, but of course, you don't want to see prices going up ridiculous amounts. So what he basically mentioned is that the overall price levels does not come down. Some commodities may see price deflation, like energy prices, gas prices, even food, grains. They have come down a little bit, but overall prices tend to move up over time in a good working economy. And they are trying to achieve that overall trending up 2%. That's what they're trying to achieve, and not these crazy numbers of 4, 5, 6, 8%. Some commodities and some items have even increased 10 to 12%, 15%. So that's what they're trying to avoid. Now, Powell also admitted that the Federal Reserve missed the Silicon Valley Bank failure and everything that went down over there earlier in 2023, and it was blindsided. It kind of blindsided them also, and we try our best to never comment on fiscal policy. So when asked about the national debt and the fiscal policy, again, Jerome Powell mentioned that we're not okay in commenting on fiscal policy, but he said that we believe that in the long run, we are on an unsustainable path. We believe that the debt is growing at a faster rate than the overall economy, or savings for that matter, and that, of course, is going to be a bit of a problem long term that the Federal Reserve is worried about, concerned about, which the fiscal department, the Treasury Department will eventually need to kind of face that problem, face that challenge, which is also one of my biggest concerns. I've already mentioned this, that's probably one of my biggest concerns about the US economy, is that long term, what are they planning to do with the national debt? Now, this right here, two most important things for US prosperity long term, he mentioned, is that we need to remember that the US has this adaptive, flexible, and innovative economy to prosper long term. And since World War II, the US has been supporting democracy, security, and economic arrangements, transparency, and we lead, and the world wants that, is what he mentioned. And finally, he said the first rate cut would likely be in the middle of this year. So March rate cut has already been pushed out to May because of what he mentioned during the FOMC. We still have 7 weeks until the next meeting. 7 weeks until the next meeting. Yes, so March is going to be pretty far away, towards the end of March. And also, he basically mentioned that inflation starts to reaccelerate then that rate cut could be pushed even further down the road. So it could be later. But if unemployment starts to move up, then that could be a little bit sooner. So of course, a lot of that depends, kind of moving cautiously on data-driven policy here. And then finally, he mentioned that we are not incorporating any politics into our decision making, but we always know, what's going on behind the curtains. But that's exactly the whole idea, is that monetary policy, FOMC, is kind of supposed to act independent of any other governing body to make their decisions. So that's the entire analysis and everything that Jerome Powell mentioned. Not a lot of difference here, but again, it's kind of nice to see that, okay, there are some rate cuts being priced in. There are some rate cuts that are expected this year in 2024, starting in the middle of this year. And then, of course, we'll see how markets kind of respond to those rate cuts happening in 2024. Markets are still pricing in, 6 to as many as 7 rate cuts in 2024. I doubt we're going to see that unless, of course, unemployment skyrockets, economic slowdown happens significantly, inflation plummets down to under 2%. Then I could see the Federal Reserve, okay, kind of easing up and warming up to the idea of maybe 6, 7, as high as 8 rate cuts, depending on the situation. But given how strong the economy is, given how strong the labor market is, and given how long it's taking inflation to come down to 2%, I find it kind of challenging and difficult. The Federal Reserve is going to be kind of motivated to cut rates more than 4 times. I think under 4 times is what we're going to see in 2024. But let me know your thoughts down in the comment section below. And what do you think? As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. We'd love to have you on board. The first week of the month is the best time to join. And make sure that you do subscribe and like this video as well. Happy investing, and I'll see you all in the next video.